Dynex Capital's 15% dividend yield is a total illusion. Think of it like an ATM machine. It hands you $15, but it takes $20 out of your account when you aren't looking. This stock has been declining for 13 years. You are literally bragging about getting a dividend check while the actual money you invested shrinks into nothing. It is a trap, plain and simple. So what is exactly Dynex Capital? Ticker DX, like the WWE, DX. It is a mortgage REIT. In plain English, they borrow cheap money to buy high-paying mortgages and they pass the profit over to you. Sounds easy, right? But it's a massive high-risk gamble on the housing market. Today, I'm pulling up the actual company stats, revealing my own portfolio, and telling you if it's worth investing in 2026. Stick around. So what does Dynex Capital actually do? Well, in simple terms, they borrow cash at short-term interest rates and use it to buy bundles of home loans. Then they collect the interest from those home loans and pass the profits to you as dividends. The trick here is that they want interest rates to drop. When the Fed cuts rates, Dynex's borrowing costs crash, their profit margins explode, and the stock goes up, which is exactly why it rallied when rates hit zero back in 2020. But when rates spike, their borrowing costs rocket through the roof, their margins get crushed, and the stock bleeds. Look at what happened in 2022. The Fed started aggressively jacking up interest rates to fight inflation, and Dynex got absolutely hammered. The share price tanked because their business model can't handle fast rate hikes. It's a highly leveraged bet on interest rates, and it explains why the stock has been in a chokehold. So let's look at the actual numbers keeping this thing on life support. Right now, Dynex Capital trades around $13 a share. It's a multi-billion-dollar company that's been around since 1987, and it actually hit all-time highs way back in 1993. Since then, it's been a slow, painful slide. The only reason anyone even looks at it is that massive 15% dividend yield, but don't let that fool you. To hide how badly the stock price was crashing over the decades, management had to trigger two reverse stock splits, one in 1999 and another in 2019. In plain English, they had to force combined shares just to keep the stock price from looking like a penny stock. And basically, reverse stock splits means that the stock is doing terrible. It moves up and down with the overall market, but its long-term trend is just plain ugly. So yes, I am invested in Dynex Capital. So here's my personal confession. I bought into this thing back in June of 2022. I was in college, or rather, I just graduated college, and I was chasing high yields like a complete idiot, and picked up a tiny position of 5 shares at around $11.24 each. My first dividend hit a month later, and since then, the monthly payout actually did go up twice. So there were 2 dividend increases, moving from 13 cents to 15 cents and then to what it is currently at 17 cents. Because I timed it decently, I'm actually up $35 between the share price bump and the monthly dividend checks. It's a microscopic play, but I'm not pushing my luck. I'm preparing to cash out, take my profit, and move that money into a real stock before this thing crashes again. Chasing a massive dividend without looking at the bigger picture is a dangerous game, and I'm getting out while I'm still ahead. So the big question everyone wants to know is Dynex Capital actually worth buying? Short answer, it depends on what you're trying to do. If you're hoping for long-term growth and want your money to compound over time, then absolutely not. The chart has been in a slow, painful decline for over 13 years, and there is no real recovery. There's no momentum, just steady bleeding. It is simply not built for long-term growth. But if you're purely chasing a high yield and want to game the Fed, then maybe, but only as a short-term trade. When the Fed cuts rates aggressively, this stock can pop. And by pop, I mean it can go up in price. We saw it in 2020, but when rates rise fast, fast, it gets absolutely demolished. We saw that in 2022. My honest take, this is a high risk gamble that's decent for trading interest rate swings, but terrible as a long-term hold. Your initial investment gets eaten away over time while you desperately collect those dividend checks to break even. Don't fall for the trap. This is not financial advice. Always do your own research. Alright, that's my full breakdown on Dynex Capital. If you've been chasing high dividend yields like I was back in college, I hope this video gave you a more clearer picture. This one is not a long-term hold in my opinion, but it can be traded around interest rates moves. If this helped you or at least made you think twice, then hit the like button. Subscribe if you want more real talk on stocks like this. Comment down below on what stock I should break into next. And if you haven't seen my last video, I did a full breakdown on Ford, so please check it out. And also, if you're not on Robinhood yet, use my link in the description. You get a free stock when you sign up. No strings attached. All you gotta do is sign up and you get a free stock. Think of it as free money. It can be valued between $5 to $200. I've actually got lucky twice and got a Microsoft stock, which right now is worth $400, and an Apple stock, which I believe is trading at around like $200 to $250. So be sure to look into that. And same with Coinbase. So use my link and get $10 in crypto after your first trade of $5 or more. So you do have to put money into this one. Thanks for watching, and I'll catch you guys in the next one.